He's like, you're really not taxing the billionaires. They don't have income. He's like, you're taxing the highly compensated.
Yeah.
Like, and whether you think that's good or not is up to you, but they're already paying about half. I mean, that's just the math.
You ready to roll?
Yeah.
Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with Magnum PI, or you guys can't see him, but Ross Marinell is rocking a killer Magnum PI mustache right now for Halloween.
Man, I feel well. One, that's quite a compliment for what's actually growing on my face right now. But I do feel like I should be in the movie Super Troopers. I don't know if you've ever seen that movie or not.
Of course.
But look, this is our Halloween edition, and we had a little business group meeting this morning, and I did attend his Magnum PI. So I'm doing my best to put a little facial hair on, but it's a struggle.
Absolutely, man. Well, you look the part. So tell me, you had a joke you wanted to tell me about candy corn. Let's hear it.
So I don't know how many of our listeners follow Mike Leach, head football coach of Mississippi State, on Twitter, but he's a must follow. He's got a pretty dry sense of humor, but sometimes he'll bring some funny. So he had a great image. He said, "How to eat candy corn. Are you ready? It's 3 steps. 1, open the bag. 2, pour candy corn into trash can. 3, eat a Reese's peanut butter cup."
My man.
So what's the favorite candy, Halloween candy in the Baker household?
Favorite candy? That's tough because the kids the last 2 years have come home with a haul of candy. Ridiculous. I would say favorites are probably Reese's peanut butter cups, Kit Kats, little pieces of chocolate, like Hershey's Kisses are great. They love suckers, so like Blow Pops, Dum Dums. We really don't let them have the gummies, mostly because gummy candy tastes delicious, but our dentists hate it, and they were like negative on the gummy stuff. So that typically disappears. But yeah, most of like any of the chocolate stuff, any of the suckers, that kind of stuff, the kids are about it. What about you guys?
Yeah, so they love all the hard candy. They're into Jolly Ranchers now, which is probably just as awful for your teeth as a gummy. And then anything chocolate. So again, neither household, we're gonna follow Mike Leach's candy corn strategy. Open bag, throw it in the trash, and go get a Reese's cup.
Candy corn is just not the way to go.
It's not. So let's jump into a couple of things. So I wanted to start with this headline. So if people were paying attention to financial news this week, they might have seen Hertz. So if you remember the car rental company that fell into bankruptcy trouble last year, bankrupt, placed a big order for 100,000 Tesla cars today. And Tesla's market cap, this was according to Barron's, gained $175 billion in value from the Hertz order, which they calculated at about a $4 billion order. Just thought that was funny because I was pulling up in Y charts, just looking at Hertz market cap and then their overall rental and leasing services category. So this is the rental and leasing services category on Y charts with a market cap of all of the businesses that fit that category of $176 billion. So essentially, with this one order, Tesla could buy the entire market cap of the rental and leasing category in Y charts.
Something smells fishy. It's crazy.
It's wild. That would include like United Rentals, U-Haul, Hertz. I mean, there's several businesses there. And so, yeah, it's quite optimistic that there has to be some assumption that this will be a continuing pattern, that they get fleet orders, that this becomes something standard as rental companies begin to transition to EVs, and that could be possible. But the optimism around that market cap swing is a little stunning.
Yeah, Tesla is one of those companies that I think, befuddles a lot of people. You like that word, befuddles, because
I like it.
I've heard it described as a religion, and we've met people that are all in on Tesla. I've seen charts where Tesla has larger market cap than like the other automakers combined. They got an S&P, so they're listed in the S&P index now. There's just a lot of stuff going on there. It's going to be real interesting to see how that story continues to play out with all these other companies I know are planning to break into the EV market. I guess the story will be, will Tesla's brand loyalty hold through and continue to spread when Ford has the F-150 Lightning truck out, and a lot of these other companies start producing EVs? We'll see if it's truly all Tesla, or if it's just people thinking, hey, Tesla is the number one vehicle brand in the game right now, but some of these other companies are going to be coming on and attacking or going after that market share. So it'll be interesting to watch that for sure.
Yeah, I agree. That was some big headline news this week. Also, a great article came across our desk. It was titled "The COVID Retirement Boom." Thought maybe we could just jump into this a little bit. But the headline from this story, this came from, I think it was the St. Louis Federal Reserve.
Yep.
This is the headline, Michael. So it says, as of August 2021, during the COVID-19 pandemic, slightly more than 3 million people likely retired earlier than they would have otherwise. And so we have experienced this a little bit within our own practice, with a number of people coming to us this year that were within their retirement window. So within, let's say, 1 to 2 years of their projected retirement, that we're looking for a good opportunity to set sail from work and just go ahead and launch into retirement. And a lot of people have picked this year and in the back half of this year. And so within our own practice, we've seen this take root. This seems to be a reality. And in a lot of ways, I understand it, because people have seen their portfolios and their net worth rebound from the lows of the COVID drawdown in the stock market in March of 2020. Locally, where we are in the Carolinas, home values have continued to appreciate as we receive people from other states, people moving from places like New York, New Jersey, Illinois, California, you name it. People are kind of coming here, whether it's weather related, to get next to their grandkids, to pay less taxes. There's a number of reasons, but it's pushed home prices up. So people who are looking to potentially downsize and get into a smaller home or more of a retirement destination, take advantage of those home prices this year. And I also know, and in talking with people we work with, people were reluctant to go back to the office and go back to that traditional sort of 9 to 5 existence. They just spent 16, 18 months out of it, and they don't want to go back. And they're like, look, I don't have to go back.
I think that's a big part of it. Obviously we're talking about multiple factors here, but I think that a lot of people did not want to go back to the office. I think a lot of people did not want to go back to the commute, the pressure of, being, hemmed in all day. And, I think of some companies have been very lenient with their workforce, saying, hey, we figured out how to work from home, and maybe they're going to be a little more flexible, allowing people to work from home. Other companies have been itching to get their people back into the office. So I think it's a combination of multiple factors, right? You have people who are, making money still being able to contribute money to their 401ks. The stock market has rebounded significantly. So people who remained invested and were continuing to invest have been rewarded for all of that. And, a lot of people are like, look, I want to know now if I can make this work. And in some cases, there's probably been people offered severance packages because companies, like they do in any time of economic crisis, companies look for ways to trim fat. They look for ways to downsize their workforce, or, and it's cheaper for them to offer severance packages and consolidate versus just continuing to have people on payroll because, they carry insurance benefits and liability insurance and all kinds of other things for these folks. But I think I'm in agreement with you. I think a lot of people, they just started looking at their account balances. They've been at home for, a year, and they just are done mentally. They just like, you know what? I'm ready. I want to know if I can do this. And so the chart you're referencing, we'll put it up on the website and in a link to it on the show. But the chart shows a graph of just the trend line for, baby boomers, especially in retirement. And there's this little blip where we have excess retirement. So, so they were counting for, I think, was it 3 million? Is that what you said?
Correct.
Yeah. Over 3 million people over what would be the normal trend have retired. And I would expect that may even continue into next year simply because we're not done with this yet. There's still more stuff coming. So I would expect that to continue, in my opinion.
So we know that as the senior staff, right, some of these retirees been in corporations 30, 35 years. They have an understanding of how the business operates, what their role was. There's going to be a void that is going to take some time to fill within those organizations to replace the work that those valuable employees can do. And we're starting to see, so really we need to see our younger generation step into those roles quickly and get their feet under them, because we know we have a labor shortage. We talked about it in the last podcast. We know there's open vacancies across the board. And you're right. I think a lot of these corporations are going to have to bend to allow people to work a more flexible schedule to be able to fill those positions and retain those employees. But it's going to come at a price. We're losing expertise in some of our most key industries. And so how long will it take for us to regain our footing from a labor perspective and not slip backwards from a productivity standard? Because we are losing some very, very talented people to retirement this year. And it's going to have some level of effect. Now, how quickly can we get those jobs filled is still yet to be seen, right? And that will probably have a large impact on how quickly we get products moving again. Hopefully we can get inflation under control and get shelves stocked. But we're going to have a lot of work to move this stuff around.
Yeah, it's going to take some time to heal because there are many things happening at the same time. You have people who have retired. You have people who left the workforce because they wanted to take care of their kids, and they figured out, you know what? We actually like homeschooling, or we actually like, our new normal. And so we want to change the routine up. And people that have left the workforce and are looking for maybe a job where they can work remote and they haven't just re-entered the workforce yet. There was a lot of stimulus money that got put out. People were given last year, access to their 401k IRA accounts to take basically a tax-free distribution, COVID-related distribution. So if they had COVID very broad. Like if you had COVID, if you were married to somebody that had COVID, if you had to take care of somebody that had COVID, you were eligible to take one of those distributions. And you either could spread the tax liability over 3 years or you could repay it. So a lot of people were given access to capital that they normally didn't have. Plus they were given stimulus money. And I think some people are just content to say, you know what, I don't want to go back to what I was doing. And I'm going to look for something that's the right fit for me. And then you've got, like you said, the boomers that were ready to be done, but maybe we're going to try to stick it out another year or two. And they decided, you know what, now this is the time I'm going to go. I do think I do think that this could bear fruit in the long run. I think that there are a lot of younger people who will now have opportunities to maybe move up and get promoted, move into, better paying roles or roles that have more responsibility. And as people move up, that may open up opportunities for some of these millennials to get, better paying jobs or to move into roles where it's not entry level type employment. But that takes time. And, we're going to see how companies deal with this, because there are jobs available, but they're still not being filled at any, type of exponential rate. So it's going to be interesting to see how this inflection point in our labor market continues to impact things in the years ahead.
I agree, and I would just say, to any folks listening that are considering retirement or a little earlier retirement than they had normally planned, sit down and really think through your retirement income distribution plan. How will you bridge any healthcare coverage gaps if you're retiring before you're eligible for Medicare? What would your retirement income plan look like? How much cash flow do you need? Do you have a pecking order of how that income will be distributed from your savings? Just button up your retirement income plan, have that really sort of crystallized, and before you make that ultimate decision, because it does put all of the things in motion that we've been waiting for 30, 35 years of working. The day you get that last paycheck is the day you've got to be ready to have your retirement income plan kicked in and in motion.
Absolutely. We actually, Ross, if my memory serves me correctly, we actually recorded a podcast called Early Unplanned Retirement, where we talked about a lot of these things for people that are being forced into retirement or opting for early retirement. So if you're listening to this show, go back, find our episode that we recorded called Early Unplanned Retirement. I believe that was the title of it. We'll make a link to it as well. But in that's all we talk about is for folks that are leaving the workforce early, things you need to be thinking about, because retirement and your retirement years are definitely different than your wealth accumulation years from an income perspective. So we want to make sure you get that right. What's next, buddy? What you got?
Well, one, let's just take a quick break and put a little appreciation on you for spending the first 15 minutes of this podcast having pretty serious conversation while you have to look at my face with this ridiculous mustache.
Oh man,
very, very proud of you.
Oh, I thought you were about to give out a shout out of appreciation to the Atlanta Braves for making the World Series, buddy.
Oh my gosh.
Is there anybody in baseball besides people living in Texas that are not pulling for the Braves to win this thing, especially after the Astros, all the scandal with them potentially cheating and winning the last time around?
Yeah, so my neighbor calls them the Asterisks.
Yeah. Well, I thought about that the other day. I was like, man, it's awesome for this area. Obviously in the Carolinas, we don't have a professional baseball team. So many of the people, myself included, grew up kind of, pulling for or watching the Atlanta Braves. And now the Braves haven't been to a World Series since the late 90s. So this is long overdue for this fan base. People down here are really super pumped about it. It's a big deal. And I just thought how appropriate that there's a true villain, because I know a lot of people were really upset about the way things played out with the Astros. So go Braves.
Go Braves. It definitely feels like a Braves town. A lot of Braves fans in the neighborhood and around this area. So we're rooting for you. And I certainly hope that they win. All right. So we've had some interesting tax proposal talk come up over the last few weeks. We've held back a little bit on sharing just to see what actually materializes into the ultimate plan if Congress gets pulled together and gets a spending plan passed. So the president was speaking just moments before we began our podcast. So I was tuning in a little bit to that, but for the first time recently, because this was just a few days ago, Janet Yellen took the stage and talked about taxing unrealized capital gains. I know that's been around for a little while and resurfacing. I don't know that it has the legs to get into any proposal right now. And I thought, just looking at all of the tax talk that's been thrown around regarding the spending plan, there was a great article by Clifford Asness. He wrote it in the Wall Street Journal. said the title of his article was Biden's real tax target isn't the super rich. And he goes on to make the case that a lot of the tax proposals would really affect the higher incoming wage earners versus the super rich billionaires who make the majority of their net worth through equity. And so it seems like we talk about proposals to tax the billionaires and sometimes just fall right back to taxing the ordinary income earners. Now, to be fair, we're talking about taxing the very high ordinary income earners. So think about your sports athletes, your television show personalities, etc., that may make millions of dollars a year that already pay a pretty substantial federal, state, and local income tax. Any kind of short thoughts on the tax talk that's been circling the last few days regarding the spending plan bill?
I don't know if I have short thoughts. I'll try to be short. First of all, I will say this is something that I'm coming to believe more and more with all of my being, is one of the greatest just mistruths or lies, outright lies, that is being told by everybody in DC is when they pass these monumental pieces of legislation, is that they're paid for, and that's on both sides. Both parties do this, and how can you say something is paid for when the next administration could come right in and change everything, and flip the program around, or take whatever you were using, whatever mechanisms you were using, and reverse it? And that's just been this tug of war that continues to happen. And I think that's been part of the problem with the Democrats' bill, because they've come out and they said that they were going to make sure it was fully paid for. And lo and behold, they can't get there. They can't get there. And that's why these numbers, these crazy, just off the wall, not thought through policy proposals when it comes to tax keep coming to the surface. I mean, I can't even go into the ways that I feel like taxing unrealized capital gains of billionaires would be a bad thing. I know that we only have a handful of billionaires, relative to the overall population, but the way that policy was being presented was it was bad policy. When you have good policy, even if we disagree philosophically about what the policy is supposed to do, if it's written well, and if it's good policy, that's one thing. When it's just, hey, you know what? Here's an idea, and that seems like the amount of thought that went into it. But what I will say is this. You were right. Biden came up today. He's getting ready to leave the country, so they still don't have a deal done. I mean, here it is. It's the October 28th. They still have not voted on anything. Nothing has happened yet, and they're scrambling because, quite frankly, the clock is running out for them to get something done. If they can't get something done sooner than later, all of this stuff may die, or people are going to have to make difficult votes in an election year. And we both know that that's not one thing that politicians like to do. But I was just reading through a few things. It looks like believe it or not, it looks like the increase in the ordinary income tax rate may not be in the bill. The increase in the long-term capital gains tax rate may not be in the bill. Even the estate tax exemption being lowered doesn't look like it's going to be in the bill. At least it wasn't laid out today. So I'm really interested to see the actual legislation when they craft it and they put it out there. But on the whole, it looks like this is a huge, huge difference from what we were thinking they might try to pass a couple months ago. We thought they were going for everything. Increase in the top, capital gain, increase in the top wage rate, compressing the next bracket to make more people go into the top bracket, increasing long-term capital gains. We thought a lot of stuff was going to happen. And I would say this is probably not even going to be a blip for the most part, unless they come out with something really different from what he laid out here. So I would say, as far as people being worried about the tax policy, this shouldn't be anything to be concerned about, in my view.
Yeah, I think let's wait and see. I don't want to dive in too much because we don't know what will become a worthwhile discussion based on what gets passed or doesn't get passed. And so it's not great to just stoke the fears of people listening either when we don't really know what's going to happen. And I think it's wise to just be calm and patient and see what actually materializes. But it looks like some of the big talking points are not going to be a part of it, as you mentioned. So I'm not sure how much else we should really share on that topic right now. Maybe just wait and see what happens over the next few days if they are pull together a spending plan, which potentially could be voted on as early as today, but most likely probably next week.
Well, I think there's a couple of things that we should make clear. One is, if you remember, there is a bill that is in the House that's more the infrastructure bill, and that's the bill that they can't bring. Pelosi has not brought to the floor for a vote. Last time we recorded, I don't believe they had the votes, but they're saying they don't want to vote on that bill until they have a bill, their bill, the House bill, in the Senate. And it looks like that bill is the one that Biden's referring to today. Was the Wall Street Journal calls it a $1.85 trillion social spending and climate package, which is way off of the $3.5 trillion number. So what's going to be interesting to see is if with now the president getting up and basically stumping for this package, if that moves the House to go ahead and vote, or if the House members continue to hold their position that they're not going to vote on the Senate bill until the Senate votes on their bill, because we kind of have that standoff, right? But these are two very different things. One, the bill that's in the House is more infrastructure related. The one that the House wants the Senate to vote on is, I'm just looking at here, a breakdown of, and the Wall Street Journal breaks it down, over $500 billion for clean energy, climate investments, $400 billion for child care and preschool, $200 billion for child tax and earned income tax credits, because they want to extend those tax credits for people. Home care, housing, each have $150 billion, $130 billion for ACA credits, $100 billion in here for immigration. So it's going to be interesting to see, like, if this thing gets carved up more, or if the Democrats, as a whole, are simply just tired of fighting with each other, and they say, let's just pass these things so we can get some legislative wins before we have to go visit our constituents next year, which I think is probably what's going to happen. So I saw this article from Ben Carlson, and Ben writes about this kind of stuff from time to time. I've seen it on Michael Batnick's blog as well. But the title of the article is Ownership Inequality in the Stock Market. And so he breaks it down, and it has a few charts, but he says the data is kind of depressing, where the top 1% now owns nearly $22 trillion in stocks and funds, which represents almost 54% of the total ownership. He says the top 10% owns 89% of the stock in the country, meaning the bottom 90% of people in the country own just 11% of the stocks. And he goes on to break down, financial assets. But, this is one of the reasons why I think people can sometimes think about, why there can be a disconnect between what's happening in the stock market and what's happening in the overall Main Street economy. And, I should say this. I want people participating in our markets, because I think there are a lot of great things that happen with capitalism. It's not perfect. There are a lot of bad things that come with. But if you look at the other economic systems out there, I think capitalism, free market capitalism overall is head and shoulders above the alternatives. But there are a lot of people that are not participating. We have one of the greatest wealth creation vehicles that's out there is the stock market. And I think about this from time to time when I'm having thoughts to myself, but I'm thinking, most people, and this isn't knocking people, but most people in our country don't have the ingenuity and the genius of a Bill Gates and a Jeff Bezos, myself included, right? There's some people out there that they're so smart and they create things and they become extremely, extremely wealthy beyond what we can imagine. But the stock market itself allows us regular folks to tap into that. You know, you get to invest and be part of Microsoft's story. You get to be part of Apple's story. You get to be part of Tesla's story if you want to, you know. And there are a lot of people that, for whatever reason, I think could participate in some way and they choose not to. And we see that bearing out in the numbers. And so therein lies a huge problem, because we have people in our country that, while living here is great and there are a lot of benefits to being living in the United States, they're not participating in our economic system. And so when we have policies like tax policy or, you know, other things, there's two very different worlds. And so that's a real issue, I think. What are your thoughts?
I agree. The numbers are the numbers, and I would say, though, the one thing that's changing, and it may take a little time for those for the stock ownership numbers to pick up steam with our lower and middle class income participants, but it's never been easier to buy a share of stock. You could open up a trading account at Robinhood or Schwab or any number of platforms. You can buy a stock without a ticket fee, so there's no charge to buy it. You can buy fractional shares. If you don't have $1,000 to go buy a share of Tesla, you can go buy a fractional share, and you can get started. So as far as the technology and the access, it's been as easy as ever for new participants to get started. And we're seeing newer participants come through channels like Wall Street Bets and through the Reddit threads, and coming up with new and different ways to attack the market. Some for the financial professionals may not agree with, but whatever. They're out there pushing the buttons, and they're trying to be clever, and they're looking for an angle, and at least they're participating. And so it's important. It's hard to convince people to do that if the resources are limited, because what we know is it takes time, it takes patience, and consistency. And so for most people, wealth creation through the stock market doesn't happen overnight, and it's a decades long process. And if you don't give yourself the time to allow that to happen, it's difficult to see the true results.
I heard a quote the other day, and it made me think. It says, "Nobody can create more time, but everybody can waste time." And we tell people sometimes, I say this in workshops: time can be our enemy, or it can be our friend. And there are a lot of people, I feel like, believe they've been left behind, and so they're either taking one of two paths. They're either, I can't get involved because, I don't have the time it takes for the market to work for me, or they're going into the crypto world and they're speculating and, wanting to be overnight billionaires. But I would say that there's still lots of time for you to invest. Even Ross, think about this. Even someone who's 60 years old, who's healthy, and if they obviously don't have time to do the wealth accumulation that, a 25 or a 30-year-old would have. But if they wanted to invest some money, if they're healthy, their life expectancy is 25 to 30 years. Now if they weren't expecting to use those funds, but they wanted to maybe put some money aside, and we've seen some people that have had a little bit of money that we've helped some people along the way, that they set aside a little piece of money and say, hey, this isn't for me. We're going to invest this, and this is going to be for my grandkids. And, they plan on, their grandkids inheriting this money. Obviously it's there if they need it, but they've set it aside and say, look, I want to invest this money and give it 20 years to grow, and it be a gift for my grandchildren when they're, either graduating college or when they, inherit it from me or whatever. So, but I saw those numbers, and it did kind of just give me pause, because from time to time people ask us, like, what's going on? And there are a lot of people right now, I feel like, have some angst about the market and what the market is doing, what's going to happen. And, any day now the shoe is going to drop. And I'm thinking to myself, well, institutional money and the top 10% of people in America overwhelmingly own our stock market. And if those people are doing okay, and if those people are still having positive cash flows, yes, there's some macroeconomic risks out there, but you've got millennials that are now working and putting money into 401k. I mean, this is a boat that I feel like people should want to be on. And I feel like it could be a mistake for people just pulling out just because of short-termism and their own, availability bias about like what they think is going to happen because of, what's been happening in their own world, if that makes sense.
It does. It's a good way for us to wrap up today. It's never too late. You can always come and participate in the markets. All right, buddy, I need to go find a sharp razor.
It's time to shave.
We'll give me a sharp blade and take care of this upper lip.
Tell the truth. You've been looking at yourself and you're like, I got to get rid of this thing. Oh, it looks good though, Magnum. It looks good though, Magnum PI. All right. Well, hey, for anyone who's been listening to us, thank you so much for tuning into the show. Give us a shout, themoneyhuddle@vcplanning.com, if there's a topic you want us to discuss on the show. If not, thank you for listening. And as always, we will talk to you next time.